We are nearing the fourth panel, which is about banking. I've said many times before that capital markets and banking form the bloodstream of the economy. So you can't have one without the other. It's like arteries and veins. Before we dive into the panel, I'd like to welcome Artur Szeski from Fitch Ratings to give an overview of bank credit ratings, about the framework and the recent trends. So warm applause to you. And the floor is yours. Go ahead.
So again, thank you very much for having me here, and it's really a pleasure to join such a big event. The word ratings has popped up a couple of times already during the discussions. So I'm here to tell you a bit more about the ratings and how we do it, and also hoping that everyone understands that the rating agencies are also providing a significant input to effective capital markets. And it's not only about ratings, it's also about research, analytics, insights. And I think that what is important to understand is that whatever we do, we try to base ourselves on very important basics. It's like following the standards of integrity, independence, and transparency, and everything really starts with well-designed and robust rating framework. Without it, ratings would be probably less meaningful. So just to encourage everyone to take a look at our website, because for some, the rating frameworks or criteria might be extremely difficult to understand. Well, it's not really the case. If you follow what we put on our website, the criteria essentials, this is very brief description of our criteria. We have loads of different criteria. For financial institutions, it's a separate one. For corporates, it's a different one. For structured, you name it. There is a lot of them, but all of them are very well explained in short videos as well. So it's very useful tool to get started with understanding ratings. Today, though, I will just try to walk you through our framework for bank ratings, because as it was said, banks have become a very important player on the capital markets from the very early days. And in some markets, in some capital markets, banks are a very important part of the market, also as listed entities, but also issuers. So if you think about the bank rating framework, what is the ultimate goal? It's obviously trying to assess the credit risk or credit worthiness of a bank or the instruments that the bank is issuing, for investors to be able to judge the risk and make their investment decisions. And again, it might seem extremely complex when you look at this chart, but in reality it's simple. So what is actually the risk investing in the bank instruments? So the bank can basically fail, right? This is the major risk. But the fact that the bank fails not necessarily means that the bank defaults on its obligations. And the reason for that might be different. It might be because the bank is being supported externally, so the creditors are not suffering losses, or the structure of the bank capital stack plus debt stack means that on some instruments, the probability of getting hit is much less than at the other level. So what we are trying to show with our methodology is just to make this distinction between failure and default. So the failure risk we measure with our viability rating. This is basically a measure of the bank standalone credit worthiness. So it measures the failure risk. But on top of that, we are also looking at the IDR, which measures the default risk. So how we get to the IDR from the VR. So this is exactly how we do it. So we first establish the viability rating, so the risk of the bank failing, And then we think about whether this can be mitigated by external support. This support can come either from the state or the government, or from the private investors or the owners of the bank. In the European Union now, the possibility of relying on external, extraordinary government support is virtually zero. This is because in the aftermath of the financial crisis, the legislation has been changed in a way to avoid taxpayer money being used to bail out failing banks. So with very few exceptions that are usually the state-owned development banks, which are excluded from this legislation, the reliance on extraordinary governmental support, we cannot really factor it in. This is different from the shareholder support, because imagine a subsidiary of a large banking group, then it really, again, depends on how the group is structured, but our assumption is that for strategically important subsidiaries, this extraordinary support from the shareholder would come. So once we try to, and we establish what is the VR or the failure risk, and then what is the possibility of the external support, also measured on the AAA scale, then we can combine this together and make an assumption or make our judgment on what is the default risk of the institution. And our approach basically is that it's the higher of. So it's either driven by the intrinsic strength of the bank or incorporates assumptions of support. And then we get to issue ratings, so different types and different levels, so senior unsecured. In some places we have 2 layers of senior preferred and senior non-preferred. Then we have subordinated debt and hybrids. And then there is whole methodology around it, how we notch these issue ratings from the IDR or the viability rating. So coming to the VR, which is the starting point, how we get to it. So we basically look in a thorough way. So first of all, we think about where the jurisdiction that the bank operates actually is, what are the risks related to these jurisdictions, and what are the opportunities related to this jurisdiction. And this is what operating environment score is about. So it's based on a very simple approach. So one is GDP per capita, and the other one is the ranking on the operational risk index, which is calculated by our sister company. And it's a kind of a matrix where we map GDP per capita with our index, and we got the implied operating environment score. As with the other scores, we can apply adjustments, and I will talk about it a bit later on. So we have kind of foundation, which is the operating environment, and then we get into the bank's characteristics. So we look at the business profile, and the key metric there is total operating income. Then we have a qualitative risk profile assessment, and then we get to financial profile, which is based on 4 key rating drivers or 4 key metrics, which is on asset quality, earnings, capitalization, and funding and liquidity. And as for the operating environment and the business profile and financial profile, we can calculate based on matrices I will show them later. We can calculate the implied scores within the operating environment, but again, we can apply a bit of adjustment just to make sure that the scoring that we have reflects best the reality. So in essence, the operating environment is important because it kind of sets a framework for the other scores that are used to derive viability rating. And as you can see, each of the scores I was talking about before has a predefined weighting. So if we have the scores, we have predefined weightings. Based on that, we can calculate what we call implied viability rating, which can be then again adjusted for 3 different reasons. So the key reason is that operating environment or the sovereign rating caps the viability rating, or is kind of almost a cap. Then you have, we can adjust for business profile or risk profile, or then we can adjust for one of the financial factors if we believe that this weight that is predefined, again, is not really something that tells the whole story. So imagine there is a bank which is very good in terms of profitability. It has a nice funding profile, but it's very thin on capital. Although the capital has the highest weighting anyway, then combined viability rating implied might suggest higher than we think the bank risk profile actually is. And once we were talking about these matrices, I think this is a simple screenshot of from our criteria. So again, I think it's relatively easy to follow. So for the banks, say, in a BBB operating environment, the implied asset quality score would be a BBB if the impaired loan ratio, which is the key metric, will be somewhere between 4% and 0.5%. And this logic goes through all the factors. As I mentioned at the beginning, the operating environment is a key element of the analysis. So I decided to put a bit of a snapshot of how and where the implied and assigned operating environment scores are. And I think the key message from here is that most of the CE is in the BBB range operating environment, and the assigned operating environment scores are also in a BBB range. We don't have assigned operating environment scores for the Baltic countries, but all of them would score BBB on implied. And again, interesting observation is, if you look at Portugal, for instance, you see that the implied is at A, but the assigned is in BBB plus, and the question is why, and the answer is there is, again, a case for adjustment, and the adjustment here is size and growth of credit. So we basically think that the indebtedness in the economy is already high, and the very fast growth of credit creates additional risks, which are not captured by the implied operating environment score. We have an interesting case also in Czech Republic, which is the reverse. So the implied is BBB, but we assign a single A, so a higher score, and the adjustment here is a sovereign rating because Czech Republic is AA minus. So it's basically, we think that, you know, the sovereign stability, rating stability, and also a bit of macro stability means that the implied score is probably a bit too low. So in terms of the recent trends, I guess we could think about it as a couple of mega trends that we see in the rated universe, and especially in Europe. So one of the mega trends is obviously profitability, which has been booming recently on higher interest rates. Now interest rates are stabilizing, not everywhere, of course, and falling, but again, not everywhere else, not everywhere. So that's one mega trend. The other mega trend, I think, which I think people miss, is a convergence story, which I will show again in a couple of seconds. Convergence between South and North. This is something which is happening, and it's happening for quite a bit of time already. And the third mega trend is M&A. This is again picked up recently. We had a bit of a pause with these processes, but there has been a pickup again in M&A activity in banking in Europe. But before we go there, this is another thing that we do, which I think provides a bit of flavor and a bit of insight to market participants, is what we call sector outlooks. Now it's the time when the sector outlooks will be out. It's probably late November, early December. And we look country by country, region by region. And what the banking sector outlook measures is just a relative measure between the previous year and our expectation for the next calendar year in terms of business opportunities and operating opportunities for banks in a given jurisdiction. So this is also picturing a bit of a story of this mega trend that I mentioned. So if you look at Spain, Greece, and Portugal, it has been on improving outlook for 2025. It has been an improving outlook in our iteration in mid-2025. While if you look at developed Europe, you have France, which is still on deteriorating because of political risk, fiscal pressures. So it is this mega trend, and I think it's important to note that. If you look at the CE, CIS plus, Turkey, Middle East, we don't see any, upside, downside in the short term in terms of the sector outlooks. This is an important distinction to make, that sector outlooks are not necessarily rating outlooks, but sector outlooks, again, measure the bank's operating conditions in a jurisdiction. So what this means for ratings. I think, again, the key message from this slide is that there is a positive ratings momentum in the banking sector, industry, or financial institutions globally. And this has continued for several quarters already. This chart basically shows you the difference between the rating upgrades and downgrades. And if you can look at this yellow line, it's still positive. It has its ups and downs, but it's still positive. And I think this has continued also in the third quarter this year. And summing up, again, our key actions in 2024, late, and 2025, this is again just confirming this mega trend. If you look at the operating environment upgrades, and remember that the operating environment is a key element that is used to assess viability rating, you can see that Greece has been upgraded. And late 2024, it was also Cyprus, and it was Portugal and Spain. So there is a trend of better operating environment scores, which allows viability ratings to be higher. And the downgrades of operating environment scores are very, very few over the same period of time. So again, this positive momentum is there, and it's there, I would say, globally. And the third mega trend I was talking about is M&A. There is a list of M&A transactions recently. Some of them have been put on hold or dropped altogether, like BBVA, Sabadell, or UniCredit Bank or BPM. For different reasons, they didn't go through. But apart from those, there is a number of large transactions, and I think the landmark transaction in CE is the recent acquisition of Erste Group of the current Santander subsidiary in Poland. It's 7 billion euro transaction for 50% stake in a bank. So it's really large. But apart from those, you have a couple of smaller transactions from KBC, for instance, some of them already completed in Bulgaria. Now there is one ongoing in Slovakia. We had a bit of consolidation in the market also in Romania. So this trend is also visible, but why it is so? And I think the answer is, valuations have gone up, which makes these transactions easier to execute. But also there are pressures coming from regulation, need to invest in technology, which means that smaller banks makes it more difficult for smaller banks to survive. And I think that this will continue for the next couple of quarters at least. So this is mostly it. And I think one observation at the very end. So we are talking about banks and their participation in capital markets. And I think the story there is that for years, banks have been active as a part of the capital market, as a part of the share story. But recently, they have become also an important player, an important issuer of debt instruments. This comes from regulation mostly because banks don't need additional funding most of the time. It comes from regulations, but the amount of issuance is really large. When we looked at our portfolio, it's about 8 billion euro that needs to be refinanced of this regulatory purpose transactions in 2026 alone. So with that, I will just wrap up. And I think we have another story about bank issuance coming. Thank you very much.
We do. Thank you for a thorough overview. Next up is Citadele Bank's Chief Financial Officer, Valters Ābele, talking about their bond journey. I could do the drop the mic or no?
Test it. It works.
It works.
Thank you everyone for coming in today. We had a lot of discussion how to place bonds in the Baltic markets. The banks are big. The banks need more money for funding local economy, for meeting regulatory needs. And let me share, and I'm really honored to share the Citadele story with the rather successful, I would say even very successful bond issues this September. So we are occasionally tapping local markets if we need tier 2 subordinated bonds. We're talking usually 20, 30, 40 million. However, if we need more than that, you need to go internationally. And I guess that's probably one of the questions I'd like panelists to discuss. What if you need 100 million, 150? They are small banks, mid-corps. How do you do that game if you're a Baltic issuer? But for us, our balance sheet is 5 billion. Let me start with a little bit of background what Citadele is. For those who don't know, we are pan-Baltic, full-service financial group. If you look at the Baltic market broadly, it's 3 tiers. In my opinion, it's 3-tier market. Essentially, you have big Scandinavian banks. We have local champions working across the board, and then you have a bit more smaller niche players. We're in the 2nd tier, and I think what's important also when you go out to the markets is to have a really good storyline behind the respective issuer. And that means also you want to be differentiating ourselves. For us, it's basically 2 names. We're Baltic and we're digital. Let me deep dive on that later. Of course, if you want to do international issue, investment grade rating is needed. Ours is Moody's Baa1 stable. And yeah, I mean, down the line, we needed 300 million MREL eligible senior preferred bond this year to be rolled over, and the offer we got, the subscriptions were 3 billion, so 10 times oversubscribed. And let me give you a little bit of high side on the how you get to that result. And then on the back of this successful issue in mid-September, we thought, why don't we roll it on? And we issued also 50 million 81 additional tier 1, which is near equity level instrument, and that one was at a coupon rate of 7.1. So again, very successful rate for us if we look at the equity instrument. To get there, I think there's a lot of homework to be done. And let me just walk through some of the items. I guess it's self-explanatory, but our approach is that you need to reflect on prior issuances. The one for us was back in 21. It was lower amount. It was inaugural. We were first time out in the national markets, and it was a hard sell. So we clearly wanted to check up what do we do different vis-a-vis underwriting process, vis-a-vis respective marketing tools, and I guess that's sort of strategic thing. In our case, we did it a year before the actual issue, and yeah, it worked out. So investment case storyline, it's about not only numbers, it's about what the bank is. Investors clearly are interested in how you manage your product portfolios, how you go forward with new initiatives. I got some slides on that in our case. Clearly, you need, if you're international, you need big underwriters. In our case, it was Citibank, Morgan Stanley, and UniCredit. There's a process of picking and choosing. It's not straightforward. It's about also legacy relationships. It's about pricing. It's about covering geography. So you need to figure out very smartly how this whole club works. In the Baltics, we did marketing ourselves because we have a fairly good coverage vis-a-vis pension and asset managers. I guess the next thing to figure out is which stock exchange and which applicable law. We did a dual listing back in 21, but unfortunately we didn't see a lot of pickup in Nasdaq Baltic. So essentially this time around we just went for Dublin. Why Dublin? It's a bit of a legacy, but I would say it's also, if you look at our investor base, a lot of investors on the bond come from UK, so therefore UK law, and therefore respectively also Dublin Stock Exchange. There were some other Baltic issuers who went that route. That means the local law offices know something about how things work, and it's also some scale benefits to be achieved here. Right. One note here is that with the choice of law comes also a stock exchange. I can only say very good words about how Central Bank of Ireland worked. So they're really substance over form vis-a-vis prospectus review. And as tends to happen, you usually do have some small correction here and there, last minute, last day, and they were very forthcoming. So you can send out the final version of prospectus and get their approval the next day. It went out well. So rating agency, auditors, I think it's important to note that if you change auditor, that prospectus has historical numbers, the respective comfort letters that they provide to underwriters will need to obtain from 2 auditors. So it is pretty big process in the background and takes a lot of time. Also, don't forget that there's an old bond and there's a process called tendering. In our case, what we did is offered at par 2 months before the final maturity on the old bond, and we allowed the old position holders to roll the old bond essentially into the new one without needing to breach 2 months funding or limit or other organizational matters. So the result, prospectus, naturally 100+ pages, investor presentation, clearly a lot of talk and discussion on the numbers. Non-deal roadshow, I think that in our case is a key change that we did back, if we compare processes now back to 21. We did a little bit of story and equity and balance sheet discussions with the potential investors months or 2 before we actually issued. It's called non-deal roadshow. You don't mention any specifics of the upcoming issue, but what it makes is actually gets the respective investor community prepared in terms of their internal deliberations, in terms of limit and admin procedures, so that when you actually launch the offer period, it's already in the progress. So right, Citadele, and that's again, I think it's important to note, it's not only about numbers and process. The main thing for investors is also making sure there is a stability down to the maturity. They want to know what you do. We're digital in terms of being able to launch a lot of new digital initiatives, be it payment rings, Clicks, our internal incubating venture platform, insurance in the app, good customer feedback on what we do, mobile app, screenshots, AI, clearly all the things on par. That's important thing. Financials, as the colleague from Fitch told, asset quality, profitability, metrics on the cost efficiencies. So that's self-explanatory. I guess what's important is to be able to comment trend, positive or negative, and also basically build up a case on how we can perform in future. Right. There's a lot of background thing, and once you do the job, I think we are able to manage it in a fairly quick process. That's the usually the week of the underwriting, and respectively. In our case, we launched a senior preferred bond mid-September, and we started with 215 bips in the morning, managed to anchor some some key investors there, issued 2 guidances and essentially tightened almost 50 beeps during the day. 9 times oversubscribed, but there was a bit of an issue with Italian investor base. Apparently they were passporting of deposit taking needed for us into Italy to be able to launch the respective investments in Italy. So much for free flow of capital of Europe, so that's clearly something that needs to be fixed. However, we ended up with, I think, very good result. The investment bankers say that this was by far the largest oversubscription for a bank coming out of Central and Eastern Europe. And then the results of 50 million AT1 bond, we needed 50 million, we got 180, but the yield was more than acceptable and good basis for bank to grow forward. Last slide, post-issuance management. Don't forget about that. So there's a lot of process after closing. So there are temporary notes, there are compliance things, there are, you need to run up investor relations stuff, a lot of registration and paperwork to be done. And on this, I'd like to thank my Citadele team, those that are here and those that are not. It's been a great job, great journey, proud to be with you guys. Thank you.
Thank you, Valters, and hope to see your bank listed on our exchange. Anyone, really, pick one. And next up, Roberts, Idelsons, please come to the stage and then ask your fellow panelists.
Thank you. Thank you. Yes, I see quite a lot of people in the audience. So yes, we're going to have a panel which will cover banks' role in the capital markets. And today on the panel we have 4 panelists. So first one is Santa Purgaile, Deputy Governor of Latvija's Banka. Santa has over 30 years of banking experience and previously served as chair of the Financial and Capital Market Commission, which was successfully merged with Bank of Latvia. In addition to her duties as a central bank, she is a member of the ECB Supervisory Board and represents Latvia at EIOPA and ESMA. She holds a master's degree in international economics and business. Welcome, Santa. Okay, second panelist represents SEB, Ints Krasts, member of the management board and head of corporate banking at SEB Bank. Ints is experienced banking executive, leading corporate client development in Latvia. In addition to his role in SEB, he drives sector collaboration as co-chair of the Finance Latvia Association Lending Committee. Ints, welcome to the panel. Third panelist represents LHV Bank, Juhan, head of Group Treasury at LHV, overseeing funding, liquidity, capital markets and risk management. With extensive experience in treasury and balance sheet strategy, he is responsible for all the LHV's debt issuances and leads initiatives to strengthen the bank's financial resilience. Welcome, Juhan. And last but not least, Vlad Ender. Vlad is head of treasury at Citadele Bank, banking executive with 15 plus years of international experience in treasury, risk management and commodities trading. After a decade in London, in Santander, Zopa and Peel Hunt, he returned to the Baltics in 2022. In addition to leading Citadel's treasury strategy, he drives funding, capital markets, investor relations and liquidity optimization.
Thank you.
Vlad, thank you to the panel. So, yes, excited to have all of you here, and today's panel will be dedicated to banks' roles, the various roles in the capital markets. Obviously, banks, as we already saw, they act as important issuers in the capital markets. Obviously, banks are also facilitators and intermediaries because most of the transactions which happen in the capital markets go through banks. And the third role of the banks are certain beneficiaries of the development of the capital markets because not only capital markets development generate additional business and additional fees for the banks and opportunities maybe to invest into capital market securities, but also capital markets create a bigger opportunities for lending development. So we'll try to touch in this panel all of these three topics, but let's start maybe as with banks as issuers, and we have two slides. Please show the first slide. So basically, we compiled some statistics on how important are banks as issuers in the capital markets, and basically we see that both in last 2 years the issuance of the bonds by the banking sector was actually more than half of the overall bond supply in the market. And please, next slide. Yes, and in terms of market cap, in terms of equities, in the Baltics, obviously, we have smaller, just 18% of the overall market capitalization represented by the Baltic banks, which is smaller than in Scandinavia, but not substantially smaller, and much smaller than in Central Eastern Europe. So I think there is a potential definitely for banking listings and improving these ratios in the years to come. Yes, but let's start maybe with a question to Juhan and Vlad. So we saw a case study of Citadele about the placement of bonds which were executed recently, and LHV has also done a number of bond placements in recent years. So my first question would be how important are actually local capital markets for you as issuers, and how much, because Citadele has chosen Dublin as a venue for listing, and obviously the bond was arranged under the English law. So does it mean that local investors are not really important for these large banking bond placements, or you see it a bit differently?
Yeah, so maybe I will start with that one. So this year LHV issued 4 times. We started with 81s, then we had an MREL, then we did covered bonds and also Tier 2s. We decided for the first time to do all the issuances internationally, and then mostly for 2 reasons. It's the market depth, of which we have talked quite a lot today, and then fair value. I mean, if the transaction is in excess of 50 million euros, and then banks in our region tend to issue when we need, not when the market conditions are super favorable. And then if the transaction is getting bigger than 50 million, there is no certainty for me as an issuer that I will get it done no matter what. So for this reason, we have decided to shift from local retail investor base to European institutional investors. And then there is a question of fair value as well. So maybe not everybody shares this view, but in my opinion, if you start paying less than 6% for retail investors, then all of a sudden nobody cares anymore. But this is not too far, but subject to timing and market conditions, that can be 50, 75 bips of where your fair value is. So there's that. So Citadele discussed the transaction dynamics before. He didn't mention that it's very expensive. So it's on average, you can expect to pay roughly 1 million in terms of different fees. But if you issue locally, of course, the modus operandi is very different. You have like a 1 or 2 week subscription period and so on, so on. But the key difference is that all this work is more or less done in-house, and lawyers are already on payroll. So there's a material difference in terms of cost base. There can be a material difference in fair value, but most importantly, I think it's a question of depth of the market. Also, there are restrictions. Tier 2s, theoretically, I could sell to retail investors. A21s, MRELs, not covered bonds. I mean, it's pays less than a deposit, so not exactly a product for a retail investor. So there are many dimensions one should consider, but since we're becoming a more regular issuer, we have put a lot of effort into building the international investor base, but by any means, I'm not excluding the possibility of issuing on a local level if I need capital or capital-like instruments, maybe 20 to 40 million.
Okay.
Perhaps to echo what Juhan was just saying, and to also refer to the case study that Valters has just presented. Juhan, you mentioned something about the legal costs and that being approximately 1 million. So not to negate the great success that Valters just covered, I wanted to perhaps touch on the topic of bureaucracy that comes together with international issuances, and to compare that to how easy it typically is to issue in the Baltic capital markets. For instance, if we want to access local Baltic capital markets, the preparation could take from 4 weeks, even perhaps 2 weeks to 6 weeks. But if we access international capital markets, that takes much more effort. And I've written down a list of documents that typically is or are required to proceed with international issuance. So amongst other documents, we have to align with our legal counsels and the investment banks such documents as subscription agreement, arrangement letter, comfort letter, CFO certificate, tender offer memorandum, process agent letter, mandate letter, issuer's closing certificate, letter to the common safekeeper, and about 5 more documents. Whereas if you would like to issue a bank bond in the Baltic capital markets, you'd probably get away with 3 to 4 documents altogether. So that is one very clear advantage when it comes to banks issuing in the Baltic markets. And of course, it's worth mentioning that Citadele started its bond issuer journey with the local capital markets, and as we grew and as we moved to fall under the direct supervision of the Single Resolution Board out of Brussels, then we only started accessing international markets to meet the larger volumes of regulatory capital.
Okay, so in the future we still should expect some bond placements on the local markets, right? Of a small size maybe, but with a cheaper overhead to arrange those. That's
from Citadele, absolutely. And again, referring to what Valters just covered, we have had this 300 million deal, but the road to the next 300 million will not be easy, it will not be fast, and it will not be next year. So probably that means we will have to access local Baltic capital markets through several smaller issuances.
Mm-hmm. Yeah, that's great to hear, actually. Yes, it would definitely help to facilitate local markets as well. So maybe turning to the other aspects of banking impact on the capital markets. So maybe a question to you, Ints. So obviously, in terms of local lending, we are lagging behind the European averages. And actually, there is one slide. Third slide, which I would like to show, which illustrates basically how much is the total amount of corporate liabilities, not only lending but also other type of corporate liabilities, in percentage to GDP in the European Union. And obviously Latvia Latvia and Lithuania are lagging behind euro area. So what's your take on these numbers, whether it's a lack of ambitions of entrepreneurs or it's some other reasons which are leading to these type of figures?
Yes, thanks for having me. And you see how much potential we have, unused potential, using leverage to satisfy our ambitions. Well, coming here, I would say politicians would answer in one way. Me being really into luxurious opportunity to work with the corporates, to see what is behind the scenes, see their plans, what is going on, I have a different opinion. And I think there are 3 reasons. One is size and characteristics of our economy. Second, characteristics of around 100,000 companies that we have in Latvia. I will a little bit elaborate on that. And the third, you're absolutely right. It's a level of ambitions and also risk appetite and tolerance levels. Let me come back to the second one. We have in Latvia roughly 100,000 companies, and also keeping in mind today's theme, development of capital markets, a number of statistics I will share a bit, triggers thinking about the potential and all that, but out of those 100,000 companies, 90% are companies whose turnover is below 1 million euros, and also one shareholder. There are 600 companies in Latvia who have more than 20 million turnover. We did analysis, what's behind, is there potential, and what are we missing, and all that. But out of those 600 companies who have turnover more than 20 million, half of those is foreign capital owned. So in one way, majority of those we know name by name. The capital that they need is originated somewhere else. 8% or 50 companies are state-owned, and roughly half is locally capital-owned. And we were looking at the leverage levels, what they have. These are the 600 companies which make up more than half of our economy, which could move the needle. So out of those 300 local capital companies, the leverage level, net debt, EBITDA, is zero. I was checking, is it right, correct number with my analysts, and it is actually true. So it indicates that, coming to the third point, the risk tolerance, and we were discussing locally the ambition levels and all that. Maybe another conference would be needed for that, but I tend to agree that it's a mix of everything what I said. We can afford, companies are well capitalized, the funds are there, even in accounts. Are we using the right mix? But the potential is really there.
Yeah. No, for capital markets development, it's also, in my personal opinion, the key challenge is to facilitate these ambitions of the local entrepreneurs to actually invest and expand their businesses and potentially go also internationally. But maybe since you've done this analysis, maybe you have some I don't know, suggestions or ideas what needs to be done to facilitate that.
We need more champions. We need more pioneers. We need those companies who stuck around 50 employees. We need their ambitions to go cross-border. We tend to see the comfort zone in Latvia, Baltics maybe, not talking about other places. We need more champions that we can have cases on. We have a number of good cases with the ambitions who also use capital markets, not only bank. And we need to have conferences like this to talk about this, to encourage others. But in Latvia, I think one of the biggest reasons is this comfort zone, local thinking. We need more ambitions cross borders, risk tolerance and all that.
Yeah, I agree. Santa, maybe you have some ideas, because central bank is doing a lot to facilitate development of the capital markets, and obviously a lot of initiatives, beautiful initiatives about the development of financial literacy amongst retail investors, which I think have led already to a surge in number of investors, local investors investing in the capital markets. But what do you think about the issuers, entrepreneurs? I mean, whether there is something which we as an industry can do to actually force these ambitions to materialize.
Yeah, actually, it's also very good to be here, and I'm so thrilled that I just remember that we started prioritizing capital market development just in 2020. 2021 we hold our first event, and throughout the COVID times, actually, we kept up, not kind of forgetting this very, very important part of our economy, how to also help economy to grow through the capital markets. And I see that not everything, of course, yet is perfect, but we are on a good path as we see the debt market growing and really good ones. And then I also quite a believer that you need time. Maybe debt issuance is as the first step, and then the company starts considering also like equity issuance afterwards, after some time already, understanding how it is to be in a capital market, to be transparent, to have the investor relations. So, and I think also as a central bank, we've did a lot, and we still are doing. We have, the sandbox up and running already. A bunch of companies every year goes through that assessment and has the homework list of tasks to complete to be really ready for the capital markets, and some of those are already there, so it's good to see that. But again, I think to your question, what can we do more to encourage also companies to look to the capital market? And also I think this is about the financial literacy and overall understanding of different financing instruments. But also as the bankers are here as well, and I still believe that at this stage of the financial literacy and overall understanding of overall financing kind of capabilities, banks still play quite an important role also as the advisor. Banks should have this ability to structure the deal when the one needs that, because if some customer goes to the bank asking for a loan, but we clearly see that this is not the case, that just the bank loan might help the situation, then what I see that instead of just saying, you are not kind of ready for the loan, or you are not sufficiently, whether, financially healthy, or you have some other restrictions, the banker, prepares the options. There are, investment funds, risk capitalists, business angels, combining the financial structure, also taking some part of that as the banker, also with some secure part for as a loan. So that might spread the message across that actually, also entrepreneurs, should come over those threats or fears that no one will finance. I will never get the financing. Maybe my idea is crazy, or I'm a bit maybe too big risk taker, and this is also if other stakeholders like risk investors or bankers kind of encourages the entrepreneur to go for this. So I think this might help for those who are still lagging behind and having less risk appetite.
Mm. Yeah, it's actually a very good point, and I think yes, banks play a crucial role in that respect as well. And since we don't have that many that developed range of financial advisors, which would be assisting also in that respect, and those financial advisors are also, by the way, not that well educated, so many of them actually lack financial literacy. So yes, I would probably agree that the banks need to play their role in terms of educating and directing these clients into other sources of financing in case they just don't qualify for traditional bank lending. Okay, so maybe let's turn to another aspects of banks, because banks obviously have balance sheets, and not all of this money they have on the balance sheets are invested into loans or kept in a central bank on a corresponding account. So my question goes back to Vlad. How much do you think local bonds and equities, local capital markets in the Baltics are interesting for banks for proprietary portfolio perspective? Because I know that Citadele is one of the few banks which actually has some position within the proprietary portfolio in the local markets.
Indeed, we do have a small book that is managed by our colleagues in corporate team that looks at the Baltic issuers and selects those issuers, corporate issuers that are aligned with their risk appetite. The positions aren't large. We're talking probably around 50 million in total, but that is again a risk return for bank, and perhaps the underlying reason for that is over the past 15 years, the way banking capital regulations have been built. Um, they've been built in such a way that essentially makes such investments very capital intensive, and for comparison purposes, it's much more profitable for banks to lend directly to those corporates, to ask for more collateral, or to issue mortgages directly to households. So it is a small proportion that is constantly receiving attention and attention from the board.
Yeah. Juhan, what's your experience in LHV?
Yeah, I mean, our business is very simple. We take deposits and give out loans, and our clients can buy and sell securities and make payments, and it doesn't really get much more complicated than that. We do have a bond portfolio at Treasury, but it's only comprising of Estonian, Latvian, Lithuanian government bonds, and that's about it. We don't take any credit risk in Treasury for the reasons Vlad mentioned. Equity investments you can pretty much subtract from your equity if you decide to buy any. And if we talk about fixed income instruments, I mean the liquidity is just not there. And as I said, we don't take credit risk in that capacity within the Treasury, because it doesn't fit in the liquidity framework of banks. Yeah, and you very neatly said it's probably the lack of collateral what gets one out of the bank and to the market, and it's probably for the corporate side to evaluate whether this risk is worth taking or not.
Mm-hmm.
Liquidity portfolios are just too big to look at those transactions, at least on local level.
Okay, so it's a bit of a different perspective. It's actually interesting to see, because I think each bank has its own internal policies. I assume SEB is not also not investing really in the local securities, right?
Different funding, policies and all that, yeah.
Okay.
I mean, if I may add, it's not so much a question about internal policy, it's about return on equity.
Yeah, I agree. I fully agree that return on equity of most of the local bonds for banks are actually lower because of the risk weight, that bonds have higher risk weights than traditional loan you would issue to the local companies. Yeah, but maybe then we can turn to the regulator with a question about maybe a broader question about the bureaucracy in general, because bureaucracy has become a bit of a buzzword within European Union, or overall context of European Union, and also including the banking sector. So we in Europe we talk a lot about reducing bureaucracy as a way to facilitate the economic growth. So Santa, maybe you can give us some perspective. Should we expect some positive changes, positive trends in the banking sector for example, in 2026?
Definitely the deregulation, simplification, those are already some like buzzwords in the sector. So definitely everyone talks about that, and not just talks. I think each institution tries to do their best to really kind of spot on some quick fixes and the things we can really change. But we all understand that they like whole European organization and different organizations within the EU, they have some their restrictions, again their policies, and for all 27 countries to agree on some one unique and one only kind of solution is very, very hard. So and that's why I think I would more kind of put emphasis on that, how to clearly reach the free capital flow through the EU. Now the Commissioner Albuquerque has said that she will really kind of force all those legislation changes for different very broad scope of different legislations for achievement of those savings and investment union, really to kind of get to the proper banking union as well, because that's how we kind of would love to see capital flowing throughout the Europe. That's actually not happening, and I think those countries like Baltics and smaller ones and more maybe to the side of the or the border of the EU will definitely benefit from this one. So, and I see that those proposals we already clearly kind of there are some indications what kind of proposals there will be. So I see that really fixing maybe already some maybe technicalities we can achieve already some more flexible reach into the capital, how actually local depositories work and how this post-trading infrastructure work. So, and not even naming the new upcoming technologies as well, what we see, what might truly change the way how we operate.
Okay, that's encouraging. Really, we need to start somewhere with this deregulation and reducing of bureaucracy, especially on the back of intentions of United States to actually further decrease and deregulate the banking sector, which obviously would make large European banks even less competitive on a global scale, also on a European scale. So there is, I agree, there is a sense of urgency to start doing something. Yes, we actually have a question. Sorry, there was a question, but I don't see it anymore. So the question was actually related to these ambitions of the local entrepreneurs, and I would direct it to Ints. So the question is whether there is this AML and KYC legal requirements toward companies, whether they play some role in this problem with ambitions of the local entrepreneurs.
I don't think so. I think these times when this was an issue have passed. We adjusted. We adjusted towards being pragmatic and all that. Also, our regulator. So I think that is not the reason.
I would tend to agree. Yes. Okay, so we don't have that much time left, but maybe let's touch upon the Baltic banking sector in general. Because there was a few years ago there was quite a heated discussion here in Latvia about the competition and need for additional players to come into the market. So how do you see this potential M&A activity in Latvia? Maybe I would direct this question to Santa. Now, do you as a regulator you see the need of additional player coming into the market to facilitate the local development of the banking sector?
No, we have 10 banks and 4 foreign bank branches operating already in Latvia. So in terms of the number, I think it's enough. Of course, we still have concentration into the market for big 4 players and then the others. But again, if we look into the market shares, you know very well that also market shares for small banks are constantly growing year over year. And this is very encouraging, and we see that the small market players who are focused on some specific niche, specifically when we see also the capital markets, the financing of SMEs. We are seeing very healthy growth there, and what of course I think that some capital consolidation also in this area still might help, but just to remind that we had quite a number of M&As also recently where smaller banks, while changing the business model, actually kind of were selling or buying each other, so or their assets, and that's why I think still, of course, as we see that in Europe there are major, I should say, major M&As happening, or we are or expecting some still to happen. I might think that maybe also in the Baltic region, banks can kind of consider also merging and kind of consolidating the forces together, gaining the capital, and then of course the bigger you are, more impactful you are.
Okay. Juhan, do you see any potential for cross-border M&As in the banking sector in the Baltics?
Well, it's almost last panel of the day, so we can joke a bit. We probably have a one-pager plan to take over every bank in the region, but this is where the joke ends. Of course, there is room on the market for consolidation, and I'm talking about competition as such. I mean, I don't remember the exact figures, but I think 10, 15 years ago, Swedbank and SEB combined used to have something like 75-80% plus market share. Swedbank's market share in Estonia is down to 37, and then I think the competition is clearly here. I personally think that they don't want to be much smaller, and then we can feel it every day. We have new banks, new kids in the block, ourselves, Coop, Artea is getting much bigger, so the competition is there, and then we don't need bigger banks to come in and ruin it for everybody.
Okay. What about Citadele? So there's been like semi-jokes floated around about your potential IPO. So, but seriously speaking, is it something you still have on the cards?
Firstly, probably to start with the consolidation topic, there's definitely room for consolidation because banks operate in a scale business. The candidates that probably are too obvious there, and I think each country has its own local champion. LHV in Estonia, Artur in Lithuania, Citadele operating across 3 Baltic states, and those are the most active probably in local banking space, the most competitive perhaps. All those 3 banks, they operate quite distinct cultures. So even hypothetically, and this is I'm talking as not as an employee of Citadele, but more of a banking enthusiast, I cannot imagine those operating together. Coming back to your question, and back in 2023, Citadele announced that it is considering a variety of potential future development options, be it M&A, IPO. As you can see, we're still not listed. We haven't merged with any other banks. So perhaps at this moment I would not be, unfortunately, able to comment on this further. But again, stepping away from my role as a Citadele employee and referring back to a presentation by investor relations panelists from Banka, one item that was perhaps missing in that presentation was price to book in each of the steps. And the price to book is one of the measures that banks are typically judged when it comes to doing IPO or any M&A or sale related transaction.
I actually asked this question to
You did?
Yes, and the answer is that, and I'm pretty sure that I can tell it publicly because it's easy to check, and I actually checked with ChatGPT as well. So the price to book was around 1 for all of these 3 transactions. Yeah. Which was corresponding pretty much to the share price at the time. So yeah, which also probably corresponds to the more or less valuation sort of on a grand European scale. But if you take a look, of course, on the equities of the banks listed in the Baltics, I think overall they're trading with a slight premium to book value at the moment, with LHV being probably the most richly priced. Yes.
Perhaps I would not be commenting on this just yet.
Okay. All right. So yeah, I don't think we have any other questions, and since we are really running short of time before the coffee break, I would like to thank all the panelists for taking part in this panel, and yes, let's continue working towards the improvement of the market infrastructure, financial literacy, and making our capital markets stronger. Thank you.
Thank you very much.